Well, I always said it would happen and expect this to be an almost, well, yearly, if not very, almost monthly occurrence. Time after time after time and time again, we will see more papers by leading economists from different universities stating just how bad Brexit really was. And not only that, very recently, there was another article that I was going to go over, but I chose to do this one instead. Um, Northern Ireland, been saying for a while, Northern Ireland's economy is flourishing compared to the rest of the UK regions. Why is that? Oh, that's why, because it's still in the customs union and single market. And is there any wonder why the Brexiteers and the hard Brexiteers ultras are now so desperate to now and essentially destroy the very deal that only a year ago they were praising as being absolutely amazing and fantastic? And oh, look, we're finally out of the EU. They do not want people to catch on that the the Northern Ireland economy is flourishing and being so much more successful than the rest of the UK because it is in the single market and customs union. They don't want people to catch on to that little nugget of information. That is why they are so desperate to pull Northern Ireland out of it. But of course, we've said time and time again, there are consequences to that. That creates a hard border between the North of Ireland and the Republic of Ireland. Can't have that because we signed the treaty, the Good Friday Agreement, and the Belfast Agreement, depending on which side of the border you're on. So again, there is no solution here being offered by the Brexiteers, who are just saying, "Well, we just need to pull Northern Ireland out of this agreement, and it'll all be solved, no problem." No, that causes a whole more series of problems that they have refused to even engage with, and this goes all the way back to 2016. But that's not what we're talking about today. We're talking about the economic effects of this. And again, they are very, very easy and plain to see because today we turn to a article on this very thing. So before we do go jumping into that, please do remember to hit that like, share, and subscribe button. And of course, down below, there are links to my Patreon page and a one-off donation link called Buy Me Coffee, where you can, well, buy me coffee. And as always, thank you very much to all those people who do support the channel that way, as well as the YouTube memberships also down below as well. So let's go jumping into this then, shall we? So this comes from the Scotsman. Brexit Britain. Here's what the financial markets tell us about the economic effects of leaving the EU. This by one Professor David Macmillan. By comparing the state of Britain's financial markets with Europe and the US, this can give us a more accurate picture. That picture is complex, but unsettling. Of the three broadly similar economic areas, the UK GDP growth has been slower since 2016 and fell further at the beginning of the pandemic, but rose faster in recovery. Economic conditions do remain mixed and very much dependent on restrictions. UK retail sales fell in December as the Omicron impaired, while the overall GDP growth grew. However, although UK and EU and UK trade in the year to October 2021 grew by 2%, equivalent EU to US and EU to China figures are 17 and 18% respectively. We can also look at business investment in the UK, which plateaued back in 2016 and remains around 10% lower than its pre-pandemic level, or even the Purchasing Managers Index, which is muted but positive as indicators whether firms expect the economy to grow. Financial markets, however, provide the best place to consider our long-term prospects. Financial markets are forward-looking, revealing whether investors believe future performance will improve by expressing confidence in the economy. And ultimately, they are where investors are prepared to put their money. Stock prices rise and currencies become strong and stable with better times ahead, with the bond market providing cover for any increasing risk. So, what do the financial markets tell us? Focus inevitably does fall on the country's main stock index. Over the 2021, the US S&P 500 increased by around 27%. A similar value is recorded for the French CAC 40. And for the US Dow Jones and Euro Stocks 50, growth was around 18%. However, the UK's FTSE 100 figure was 14%, and it is the only market to remain below its pre-pandemic value. So we see growth as the economy recovers from the pandemic, but slower in the UK than other markets. At the time of writing, an investment made in the beginning of 2020 would have returned 37% in the US, 13% in Europe, and minus 1.5% in the UK. The stock price to earnings ratio is the alternate judge of the investor confidence. And a higher ratio indicates investors are willing to pay more for stock now on the expectation of strong future performances. The UK PE ratio is lower than that of the US, France, and Germany. This means that UK stocks are relatively undervalued, increasing doubts about expecting recovery of the growth of UK economy. This has prompted Goldman Sachs to suggest that investors buy cheap UK stocks as they must inevitably catch up. However, they made a very similar statement at the end of 2020, and international investors remain less convinced that they are likely to withdraw the money from the UK. With at least 4.4 billion leaving the UK in equity funds back in 2021 and 21 billion pounds since 2016. Consideration of capital flows brings us to another key market, currency. While the stock market respects one indicator of confidence in expected economic performance, the exchange rate reflects a wider measure. The investors seeing UK assets, whether these are stocks, bonds, property, land, or companies to take over, first need pounds. Capital flows respect the confidence among international investors in the whole economy, with vast sums traded daily. It is in the last survey of the Bank of International Settlements noted that at least $6.6 trillion of currency are traded every day, including $844 billion in pounds. So how has the pound actually fared against the US dollar in comparison to the euro? Over 2021, the pound fell by a small margin, around 1%, while the euro fell against the dollar by 7%, with a corresponding rise in the pound against the euro. This seems like a good indicator, some confidence in the UK. But from the longer perspective, with the pound at 8% weaker and the euro essentially has been unmoved since 2016. And the evidence points towards greater volatility in the pound over 2021. Statistical measures and fluctuations reveal the volatility of the pound and dollar rate is over 20% greater than that of the euro dollar rate, with the coefficient of the variation at least 8 times larger. And the heightened volatility indicates very numerous and nervous amongst investors who are very quickly to withdraw their money. Greater volatility also does come with increased risk for investors and cost for exports and importers, and the shift in the pound of affecting both the value of portfolios and goods. So do the market indicate investors about the concerns for the long-term performance of the UK economy? Here we can look at the bond market for government debt. Investors buy bonds because they provide a guaranteed return. Confident investors buy bonds. Confident investors then sell them, as high returns can be earned elsewhere. As the inverse relation exists between the bond price and the yield, confidence in future performance of the UK would manifest itself in higher yields. This is what we see in the short to mid-term. But with lower long-term than mid-term yields, investors are buying insurance, which shows that doubt does persist. The UK remains an important financial centre. It is the largest market for currency trading, around at least 43% of the trading based on the BSI surveyed cited above. The UK stock market did witness an increase in new stock market listings, with at least £13.7 billion raised in the first 3 quarters of 2021. Notably in the financial and technology firms. This is more than other European markets individually, although it is less in aggregate. with London no longer the largest European share trading market. Although this is indeed mixed news, evidence from financial markets leads to two very clear conclusions. UK stocks are underperforming compared to their main competitors, leading them to being cheap. And the currency market is experiencing greater volatility, which introduces additional risk to the economy, and overall, our long-term future does look uncertain. So overall, the economic outlook is not good. It is not good at all. And I expect 2022 really to come home to roost, because remember, at this moment in time, the Conservatives are crowing from the rooftops that the pandemic is over, the pandemic is over, it's all good, we can return to business, we can return to normality. Meanwhile, of course, Brexit still ongoing, still going to be causing continuous problems because they've refused to acknowledge that Brexit is even causing any problems. And of course, the more that happens, the more they will have to try and address it. But of course, they won't address it because, as they've said before, Brexit is meant to be perfect. It should work out. It should have all these wonderful bells and whistles on it that, should be sounding off all the time. And as we've said before, if Brexit was really working, they would be crowing from the rooftops. Look how good this has happened because of Brexit. Look how what Brexit has done for this. That is not what we see from them. Instead, it is quietness, and, well, they'd far let the newspapers do that instead, crowing about very minor things like, oh my God, we can have a crown back on the pint glass. Brexit. It's like, that's where we are. But this is all goes back to the predictions we made back in 2016. Brexit is not going to be good at all. I think 2022 is going to be the year when it hits. And of course, they're going to try and blame COVID again. And the further, again, we get from COVID, the more the excuses are just not going to wash. Ironically, in a way, COVID was one of the best things to possibly happen for the Brexiteers, because it has provided so much cover for them to blame that on, rather than looking closely at what's really going on with Brexit. So as always, thank you very much for watching. Please remember to hit the like, share, and subscribe buttons. And of course, down below, there are links to my Patreon page and a one-off donation link called Buy Me Coffee, where you can do Buy Me Coffee. And as always, thank you very much for watching, and we'll see you all